and the world of business. That is, for example, entrepreneurship, starting up your own business, maybe going to buy land, maybe being a broker, maybe being anything that you would want to be. And it doesn't matter who you are. If you would want to earn a little extra income out of your savings, now financial markets are the way to go. We look into a market where we don't sell maize or tomatoes or onions, but a market where we sell instruments that are based on the need of the capital, people who need capital, and the people who are looking at gaining shares from specific companies, or actually are able to give money away for some time. Now, this is the way the financial markets are structured. Just two sets of people coming together with mutual benefits. And now the two sets of people are the investors, number one, you and I, who are investing. And then the second set of people are the people who are borrowing this money for a given period of time to use it to grow, to use it to provide services, to produce goods, or to make actually more money, to increase their revenue. And when they do so, they are able to actually return value to the people that were able to give them this money. Now, this is a preferred way of raising capital compared to going to the bank and borrowing expensive loans which come at very hiked interest rates and that are really short term, but these are long-term investments of patient capital, where individuals that are willing to part with money meet with individuals that need that money to use it to grow and expand. Now, the benefit for both parties is very evident, given the fact that companies that come to, for example, the stock market, to be able to list, are able to gain this capital. When they get this capital, they're able to grow and expand, get more employment, employ more people, also grow and maybe increase the production lines, maybe also start exporting to other countries. That is bringing in a little bit of foreign exchange. But also, when these companies make money, they have a reward for their shareholders. And that reward could come in several shapes. Number one is through their dividend. Every financial year that a company that is listed on the securities exchange actually has witnessed, they have to issue or publish their financial results. And when they do so, if they have made a profit, they must pay some of that profit back to their shareholders. And of course, that's not a mandate, but as a company that is listed, that is one way of keeping your investors. Because if you would want people to keep investing in your company, then you must make sure you're giving them some return, some sort of reward, some sort of incentive to keep them around. And this is through what we call a dividend. And we have seen companies that don't issue dividends in pricing because people sell off their stock quickly and they're willing to give up their stock and be able to go and move into other companies or move into other business ventures or invest in other things simply because they have not seen value for their stock. And every time people don't see value for money, people are willing to run away. And so companies try to at least issue a dividend every financial year, and that dividend is declared by the company and approved by shareholders during their annual general meeting. The annual general meeting happens also once every financial year, and the company is able to come and demonstrate its performance. It demonstrates its figures and the financial results, and also if there are any dividends that it would want to issue to the shareholders. And when the shareholders are able to consent to these financial results and also are able to consent to the dividend that the company intends to declare, actually they are able to be issued. And so these dividends are just a percentage of this profit that the company has made, that the company gives to shareholders, depending on how many shares that the shareholders are holding. Now, that is just a single way of the way companies reward their shareholders or add value. Now, some other companies choose sometimes not to issue dividends for some reasons, maybe because of regulatory hurdles, because the regulator, maybe for example of insurance, the insurance regulatory authority could come up with some structures that don't enable companies to issue dividends. They can issue what they call a bonus issue. And this bonus issue, excuse me, and this bonus issue is simply an increase in the number of shares for each particular shareholders, depending on the shares they have. You can say maybe 1 to 2 or 2 to 1, that for every 2 shares, we're going to give you 1 extra share. And then that is increasing still the value of the shareholders. They issue these shares in a bonus issue free of charge to every shareholder. Each and every shareholder is able to get at least some extra shares on their current amount of shares in order to be able to see value, to grow, to see that whatever they invested, they are gaining a little bit more out of it. Another way that companies reward their investors or companies reward their shareholders is through what is coming to be known as the rights issue. Now, the rights issue is where we see the listing of new shares at subsidized prices sometimes, and these shares are issued for only the current shareholders. So you cannot have people that are not shareholders come to buy these shares. So you come and actually be able to buy these shares that only shareholders are able to buy. So they're less competitive, and you see that your value also increases on the stock market. These are some of the ways companies get to reward their shareholders. But also, being a shareholder in a company, you are able to take part in decision making for this company. For example, on every annual general meeting, the shareholders are mandatory participants in this meeting. You're supposed to go and attend this meeting. Not only that, contribute to maybe if they're electing new leaders, if they have maybe appointed new leaders, approving those new leaders, if they have declared a dividend, approving that dividend, approving maybe a bonus issue. And these are mandatory roles of every shareholder for every single company that is listed. You must attend the annual general meeting. And if you don't attend, it's up to you, though that is to your own disadvantage, because you will not have taken full responsibility as a shareholder with a certain company, because you are a part owner of that company, and you must know how business is running in that particular company. Now, those are some of the ways this market benefits the normal person, the public, and as well as the companies that are listing. Companies that are also listed gain a good reputation before the public, because if you go through the scrutiny of being a listed entity, it is quite rigorous. Not that they wouldn't want companies to list, but the Security Exchange wants to make sure that the company that is listing is a company that can add value, first of all, to the public, a company that has good governance, a company that can actually be able to grow and expand with the time, and is promising and is a profitable entity or company. That is the only company that can be listed. So companies that are listed also gain this reputation that they have been able to pass through such a very rigorous scrutiny, and this gives them a market advantage over other companies that may not be listed but are dealing in the same products. So people tend to trust products of companies that are listed, because that way they think these companies have been tested and proved, and these companies are profitable. These companies are governed by very competent leaders. They have good governance, and they have good management and good employment. So all these are benefits that come with the stock market. And this market is called a capital market as well, because we raise capital through this market. It's an avenue that gives chance to people to raise capital, and this capital is patient, because you don't see much that you lose as a company by listing, and you don't see maybe paying interest rates like we are seeing on the loans that people usually want to take and invest in their businesses. So yeah, you can think about it. If you have a small business, if you have a big business, it doesn't matter. You can approach the Uganda Security Exchange. You can go to Nakawa Business Park and visit them and see if your company can also be listed. This is a way to raise capital. Loans are not the only way, and loans are just a way maybe to boost your business in some way that a business is already grown and maybe you just want some extra money for the quick. Maybe quick, you want to change something real quick. Maybe you want to increase the production lines, or you want to maybe increase your subsidiaries. That is the way loans can really help. But in the case of raising capital, the capital markets come at the forefront at helping companies raise enough capital to be able to grow and survive. And so with those benefits, shareholders can be able to buy shares for the very first time in a company by taking advantage of the primary market. Now, the capital market is divided into the primary and secondary market simply because the very first time a company is listed and issues a certain amount of shares on the market, they give it a grace period, maybe a period of 1 month. For example, MTN wanted to list, they give it a period of 1 month for people who are interested to buy shares for the very first time in the company for that period. Now, those people who buy those shares are buying shares at a fixed price that has been fixed by the company itself, depending on what they think is the value of their share. Yeah, they can say, we think that according to our performance, according to our production, according to the value of the company, each share is going to go for 200 shillings for the very first time. And people who are interested and maybe they see opportunity in this, they're able to come on board and purchase these shares. And you can purchase as many shares as possible, definitely given the amount of money that you can afford to be able to give away. But then after this period is done, the company closes the primary market, meaning now shareholders are no longer able to buy shares from the company. And this is what some people don't get. Some people think that all the time you're buying these shares, you're actually buying them from the company. No, this only happens on the primary market. And this primary market is known as the initial public offer, or the IPO. And it happens for a specific period of time. Now, when this period of time is expired, or when this time actually runs out, you go on to what is known as the secondary market. Meaning now the company is officially listed on the securities exchange, and now you go to buy shares from the people that are already holding shares. You can no longer buy shares from these particular companies that have already been listed. So in this secondary market, we see movement in prices. We see that prices are not fixated, onto one figure. Prices are determined by the demand and the supply models. Just the way we know in economics, the economics of anything or any commodity on the market, the economics of tomatoes, the economics of bananas, the economics of clothes, the demand and supply is what plays on the market. Just the way we trade any other. On the secondary market, we are looking at demand and supply. Now, when this demand and supply of a certain share is, maybe the demand is high, and you see that people are yearning to buy this stock from the already people who are already possessing these shares, you will see the value of that share go up, because every time you have something on demand, you have its value going up. And so the Uganda Securities Exchange gives a 15% window for every share price. So if the stock is at 200 shillings, it means, okay, let's say 100 shillings. Yes? So if it's at 100 shillings, meaning 15% is 15 shillings. So you can find someone trading at 115 shillings. That's okay. It is still within the 15%. You can find another person selling at 85. That is still okay, right? So long as you're within that window that is provided for by the Uganda Securities Exchange, you will see that the markets will move according to how this demand and supply plays out within that 15% window. If more people are willing to buy the stock at higher prices, you will see the price move up. If people are willing to buy at lower prices, you see the stock going down. And usually this comes when we have the panic selling that we can see on the market. maybe people have seen something on the market and they want to get back their money real quick. People are willing to sell at lower prices then. And then that's when we see the stock pricing going down. Now, when the stock pricing is going down, definitely that's a time for people, for seasonal investors that are long term, to be able to purchase themselves shares. When they purchase these shares, they can keep them for a while as long as they think that these shares will gain value in time, and then they can sell them when the stocks go up again. This is simply how the market operates. There are special cases where, for example, the exchange sees that a certain stock is not trading. Maybe, let's say, the prices are very high, and if the exchange feels like this stock is not going to trade in a very long time. Now, the stock exchange has the mandate to open the market to trade at any price. They remove that 15% window and enable shareholders to be able to trade at any price for a specific period of time. Maybe they can say 1 or 2 days, and they can have specific reasons really why they're doing this. One of them could be because the market on the stock, on that particular stock, hasn't been trading for a long time, and they are seeing a lot of dormancy on the stock market. So they would want at least some activity. So they can open the stock for any pricing, meaning if I told the stock, let's say for example, British American Tobacco at 15,000, they can open it and say, let's have anyone who is willing to buy at any price, or anyone willing to sell at any price. If you're willing, you sell at 100, and you see someone who is selling at who is willing to buy at 100,000, you make the deal. And the deal is when a buyer with a specific price meets a seller who is willing to sell at that particular price of the buyer. When the two meet, and usually this is through their stockbroker, when they meet, we have what we call a deal. Now, when the deal is done, you will see that that particular price will also move depending on how the deals move. If the pricing has been very high and maybe shareholders are willing to buy at lower prices, we will see the averages of that stock price, particular stock go down. And therefore, that's how we see, for example, at the beginning of this year, British American Tobacco Uganda was trading at 30,000 Ugandan shillings. 30,000 for every stock that they were selling. But in no time, the stock price had reduced to 50% to around 15,000. Now, this was after the Uganda Securities Exchange opened the market, what we call an open day market, where we see shareholders being able to buy or sell at their convenient pricings without any limits. And so the exchange said, okay, so it seems people are more willing to buy or sell at 15,000 than 30,000. And then that definitely drove the pricing of this particular stock from 30,000 to 15,000, where it is even up to now. That is how the secondary market works. Before 2015, we saw that the companies that were willing to buy or sell stock were actually competing on the trade floor, what we call a trading flow. And the trading flow is where we see the stock brokers come on board, and then the stock brokers are making a lot of noise, and there's a trading manager in the center who is trying to actually capture what these stock brokers are saying, because a stock broker is literally the person who represents you on the market. When you approach a stockbroker, before 2015 when we went online, you would approach the stockbroker, you fill a certain form, they give you, you wanted to maybe to buy shares of, let's say which company was there then, maybe Wumeme. Let's say Wumeme was trading some stock. So you would want to buy shares in Wumeme for the first time. You as an individual, you go and say, you talk to your stockbroker, you give them some money, maybe that I'm willing to buy stock at 300. But maybe you saw that the pricing of Wumeme was actually 312 the day before. So you go with this 300, maybe you can say you want 1,000 shares. And so you go with 300,000. And this 300,000, you want to buy 1,000 shares. But remember, the pricing was 312. Now, what the exchange would do is you would have all these stockbrokers from the different brokerage firms on the trading floor making noise. For example, you have someone who is willing to buy at 300, and then this other person is saying, there's a client for a certain stockbroker who is selling at 300. And when these two scream and the trading manager hears them, definitely he will make a deal and say, these guys are making a deal, because you can see someone is willing at 300 to buy shares and another one is willing to sell at exactly 300. And when they make a deal, probably depending on the number of shares that someone has bought, that would affect the pricing of that particular stock, either going down or going upwards. The more you trade on a certain stock, the more you see the movement in prices. The less you trade or the less active the stock, the more you see stability on that particular stock. But in 2015, due to the transformation of from the local traditional way of trading and to the online and technological advancement, sort of trading, we can see that the exchange moved away from the trading flow experience. Although if you can remember, those were good old days when people used to really actually see what really the stock market looks like, but of course with very many other underlying factors within that kind of process. So the stock exchange now moved away from this online, this traditional trading flow system onto an online platform, where now people don't have to go to the trading floor. People can cut or make deals online. You can just simply go online and look for a person who wants to sell stock, and if you're willing to buy at that price, you make a deal. And that's how deals are now made. And through stock brokerage firms like Standard Bank Group, that is SBG Securities, through UAP Old Mutual, you see Dyer and Blair, you see Crested Capital. These four stock brokerage firms that have remained for now are helping people to be able to purchase stock online without need for them to move even to their offices whatsoever. All you have to do, open an SCD account, that is a Securities Central Depository account. And when you open that account, using, of course, you can visit www.useeasyportal.com. By opening that account, you're able, using, of course, your identification, that is a NIN number, and your passport number if you're, for example, a foreigner. And then when you open that account, you go to your stockbroker and you start trading stock. When you buy stock, you see that your SCD account is credited, and every time you sell, your SCD account is debited. And all this space is regulated by the Capital Markets Authority, who are at the top of the regulatory body, at the top of the regulatory work and framework of this particular market and space, seeing that the licensed brokers are doing what they're supposed to be doing, the shareholders are doing their part as they're supposed to be doing it. Also, the Uganda Security Exchange is also doing its part as it's supposed to do it. And this is how briefly the stock market really works here in Uganda. And if you're a first-time investor, I'm glad that you're here. You can start with opening an SCD account, which is absolutely free of charge. You don't have to pay a single coin. You don't have to buy a single share. You don't have to, own a certain amount of money. No, all you have to do is to dial star right now, 165 hash, and you go to option number 6. That is financial services using your MTN. That's what we're talking about here. And then you go to option number 5, which is using the Uganda Securities Exchange. Then input your personal details. That is your personal national identification number. You input your, secondly, you input your maybe passport ID or national ID. And so you just have to follow all these simple steps, and they will be able to open for you an SCD account. It has an account number which you can take note of, and that account number is what you will be using to trade online. You don't have to visit the exchange. You don't have to move to an Akawa Business Park. You don't have to move to the stockbrokers. They will assign you a stockbroker who you can get in touch with, maybe online, maybe, or you can give them a call. You never know. And you give them a call, they give you guidelines on what really needs to be done, and you will start trading. Simple as that. That's how simplified the market has become. And of course, due to technological advancement, we are seeing very many innovations coming around these kind of markets. We see that people have moved away from the tradition, to the online trading, with people coming up with apps, people coming up with all these USSD codes like Otex East Africa, which has come up with Zabu. We're seeing all these innovations because there has been the entire country has realized how important these markets are and how we should, as a country, participate and be able to trade in some of these, very attractive markets. Definitely, that was just a little background which I always want to give, because many people come to the show maybe for the very first time and they have no idea what's really going on. They want to know about the stock market. They want to know about all these figures we are talking about and why we are interested in all these graphs and all these other, shifts in pricings and all these, year-to-date performances. All this is for you to understand the fact that this market works like any other market. You just need to understand the dynamics. You just need to understand, what it takes for me to actually start to invest. And all you need to do is get started. That is the last thing. The bottom line is get started. That's the only way and the best way you're going to learn, when you actually participate on the market. That's the best way you're going to learn. We're going to go into another quick break. We return with the other performers on the market. We saw Centum and Kenya Airways come on board yesterday very strongly, despite the fact that over 7 counters lost on the market. And we are going to see if these are investable or if this is just a temporary shift that we are going to see fade. Don't go anywhere, stay with us.